wrap-up organizations, they have a net operating income 60,000 and average operating assets 300,000. The required rate of return for the company is 15%. What is the division ROI? What is the ROI? David.
Just give me a minute, please.
David, what is the formula for ROI?
It was just in the previous slide.
Net operating income divided by average operating assets. Sipaday, Chandra.
The calculator.
Min, Aroni.
20%?
Exactly, 20%. This D part, D, 20%. Because 60,000 divided by 300,000, answer is 20%, right? Because we are calculating ROI. So this required of rate of return is given on the residual basis method. So this is extra information right now. So Redmond Awning division of wrap-up corporation has net operating income and net operating assets. So if the managers are evaluated on the basis of ROI, will she want to make an investment of 100,000 that would generate additional net operating income of 18,000 per year? What does it mean? It means income going to be increased to 18,000 while the assets are going to increase from 3,000 to 4,000. So what would be the ROI now? Can you calculate? 78,000 divided by 400,000. What is the ROI now?
Is it 19.5?
Well done, 19.5%. Right? In our previous example, the ROI was 20%. So if the manager is basically rewarded based on ROI, he would not choose this project. Right? He would say that no, I will not. Because why? Because my performance is basically evaluated on the basis of ROI. And this is not increasing the ROI. So I'm not gonna take this opportunity to buy an asset worth of 100,000 and that asset generate additional 18,000 income per year. What if, so the company required rate of return is 15%. Would the company want the manager of the Raymond Awaning division to make sure to make an investment 100,000? So okay, if we solve this with other method, which is residual method, then can the company be able to adopt this option or not? So what is the residual income here? Residual income going to be net operating income minus average operating assets multiply by required rate of return. So average assets right now 100,000. 15% is the requirement. NOI is 18,000. So does this generate a positive residual income or not? So 18,000 minus 15,000, answer is 3,000 positive. So look at the deviation of the both two formulas. ROI says do not accept this one, but residual income says accept this one because it is giving us 3,000 positive residual income. So on the basis of residual income, manager will say yes. Chandra, you understand now?
Yeah.
Okay, good. David, you understand?
Yes, sir.
Good. So answer going to be a yes here. But now, can you find out the complete residual income? So the same company, in net operating income is 60,000, assets are 300,000, right? So what is the residual income here? Please find out that.
See?
Answer is
See?
D or C?
I said C. C.
C. So answer is, let's say that 15%, so 300,000 multiplied by 0.15, and you exactly. Answer is C. Well done. So that question again, if that manager, I think this is a repeating one. Yeah, we just talk about that. If he, based on residual income approach, he would select yes. We'll just talk about that. So this is the approach here. So which one is preferred one? Residual income, because it gives you. So we started our journey for this lecture that, and we maintained an argument. The biggest problem with the decentralized organization is that the decentralizations act as a barrier in innovation. So we proved that here, right? So if we are using ROI, right? So ROI, if manager want to innovate, so ROI does not let the managers to innovate. So that's why we need a new method. We call this residual method. So we compare both methods and we find out that, okay, residual method is more appropriate. So there are some drawbacks of residual methods. Yes. So residual method income approach has one major disadvantage, that is it cannot be used to compare performances of divisions of different size. And that makes sense as well, because you can only compare apple to apple. You cannot compare apple with the mango or apple with the banana, right? So let's talk about that. So okay, we have a retail division, we have a wholesale division. Look at the size. Retail division operating assets only 100,000, while the wholesale department have average assets of operating assets of 1 million. So the organizations, they gave minimum requirement 20% and 20% both. So both managers has to earn 20%. So their target is the retail department must earn at least $20,000 and wholesale department must earn $200,000, right? Okay. For example, the both completed their targets. So here, the retail division earned 30,000 and the requirement was 20,000. So they made 10,000 residual income, right? Whereas the wholesale, they also beat their target, but only for 20,000. And their residual income is $20,000. Now, you tell me, who performed well? Whether retail department performed well or whether wholesale department performed or outperformed? And that is the biggest challenge, right? So you tell me, which department outperformed? If we base our number on the basis of residual income, we'll say that wholesale department, it skyrocketed. Why? Because its residual income is $20,000, while the retail department, its residual income is $10,000, right? Let's talk about here. If we base our argument based on ROI, so ROI is net operating income divided by the assets. So in that case, 30,000 divided by 100,000, answer is 30%. While net income divided by the average assets is 22%. 220,000 divided by 1 million, answer is 22%. Now you will see that there is a conflict. If we choose ROI, retail department outperformed. If we choose residual income, wholesale department outperformed, right? So this is, and we say that residual income is a good measure. It eliminates the traditional criticisms or the biggest criticism on the ROI. But look at that here. What happened here? So in that case, we simply say that the residual income is not applicable to those departments who is not of this, compatible size, right? And why I give you a simple small example. So it is easy to earn 10% on $100, right? $10, right? David,
Yes, sir.
it is easy to earn $10 on $100 investment, right?
In most cases, yeah.
But is it easy to earn 10% on 10 million? Answer is 1 million. Is it easy as compared to $10 versus $1 million? You tell me. Earning $10 is easy, or earning $1 million is easy?
Of course, the answer is obvious. Yeah.
Right? So simply we cannot compare the investment of $100 with the $10 million. Plus the 10% itself is just a ratio, right? And ratio makes sense if we compare with the sizable things. Otherwise, it doesn't make sense, right? So you see here, if you now see again the answers, so you can easily see that they earn 22% on the top of 1 million. Of course, their efforts